Welcome to the Daily Update, where I'll go over the action in the market for Friday, October 27th, and then we'll see how things look for Monday, October 30th. We had another down day. Things are not looking all that good for the rest of the market. The mega caps held up pretty well, and in the wake of Amazon's earnings report, some of the big companies ended up doing a little bit better. You had the semiconductors also doing better on the back of Intel's earnings. But right now, we're still looking pretty positive. We're breaking below support. We're wondering now, is support going to be found at some point? And hopefully, as I go through the charts, you'll see some of the things that I'm talking about. Let's go back and talk about what happened. Right at the open, we did have a higher open. And we were at the daily pivot at 41.50, and prices chopped between the daily pivot and the unchanged level. Not necessarily a surprise. When we see a little bit of a gap, either up or down, it's very common to go back right after the open and fill that gap. And then the market decides what it's going to do from that point forward. As the day went on, prices then broke below the unchanged level. So the market wanted to go negative, and we fell to S1 at 41.16. Prices chopped above and below S1, and we closed slightly above S1. So now we've been dealing with 4,300, 4,200. Now we're starting to deal with 4,100 as the market continues to go lower. We were down 0.48% on above average volume. Our technicals are negative across the board. We are seeing some extreme negative readings now. We're wondering, is the market going to find some support at some kind of level and be able to bounce up off of that? Or are we going to continue to go lower? It's about inflation, interest rates. We had some big inflation reports out that I'll go through. It's about earnings because we're in the middle of earnings season. And it's also geopolitical because of what's going on in Israel. And now I've also added Syria to the list. There was some U.S. bombing that took place in Syria. That has a potential connection to Iran. You've also had Hamas going to meet with folks in Moscow. That could really set some escalation fears in motion. We'll have to see if things stay kind of where they're at right now, or are they even going to get worse? It's not looking like they're going to get better in at least the very near future. Hope I'm wrong about that. Here's some comments. The S&P 500 is now testing the 4,100 level, and we're down over 10%. We're down 10.3% from the July 31st high that we set, and I have a chart to show you of that. The U.S. did carry out airstrikes against Iranian-backed targets in Syria. You know, the U.S. and Iran have not been very good friends since 1979. And then separately, that Israel is going to expand their ground operations in Gaza. You have the media and much of American society against Israel right now. On the other hand, you might say, well, Israel does have a right to defend itself, but that appears to be escalating. The NASDAQ and the NASDAQ 100, they did have gains in Friday's session, led by Amazon and Intel. And the three strong sectors, you have communication, tech, and discretionary. They were up on the day where the rest of the market was down, with energy really leading things lower. It was the weak sector for the day. And then you had Jamie Dimon, the CEO of JP Morgan Chase, came out and confirmed that he and his family plan to sell a portion of their holdings. Of course, that sent waves through the market. The people that listen to Warren Buffett and different hedge fund managers and Jamie Dimon, they react when they come out and actually make this news known. Small and mid-cap stocks were down. They were up in Thursday's session. They ended up being down again on Friday. Oil was up at $85.54 per barrel. The microcaps were actually hitting another new 52-week low now. They were down on the day. Our list is pretty long in the short term with extreme negative readings. The 20-period exponential moving average, which was off the list, now it's back on the list. We have the CMB composite, the Stochk RSI, the Williams percent R, the force index, both the CCI 14 and 20, the stochastics, the RSI, and the boom indicator based on 20 periods. Intermediate term, we're getting a pretty long list here too. We have the 50-period exponential moving average, standard deviations chart, and two new charts are the rate of change going back 10 periods and 20 periods. The Arun, which is acting kind of crazy. The McClellan oscillator for the S&P 500, the PMO studies, the Sean trend meter. the bullish percent index for the S&P, and now we have the BPI for the NYSE. That's a broader measure that's starting to get oversold. The ultimate oscillator, the RSI based on 14 periods, and the boom indicator based on 50 periods. Whew, pretty long list here. Long term, we still have the 150-day moving average and 200-day moving average study. We're still going through this same basic scenario that hasn't changed for a couple of months now. And this was played out a bit in Friday's session with the economic reports showing that the economy is stronger than expected and that the Fed will need to keep rates higher for longer and possibly even have to raise rates. Keeping an eye on the Chinese economy, they're adding stimulus to the economy, which may end up helping, but that can take some time. And the reason I bring that up is there's so many companies, S&P 500 companies specifically, that do business with China. What's going on in Israel, what's going on with oil prices, and then earnings as they are released. The dollar was down just a little bit, but it's still in a pretty solid uptrend. Interest rates ended up being unchanged. That really didn't give much support to the market. The 30 to the 5 and the 10 to the 5 are back to being normal, where we have the 10 to the 2 and the 10 to the 3 month showing improvement, but they still remain inverted. Sentiment, we're starting to get pretty extreme now. There's a lot of pessimism going around. We've dropped below 25, where we closed at 24, where after Thursday, we were at 26. Our trend is comfortably negative, and I don't mean that in a good way. I just mean it's pretty defined. The ADX is above its moving average, and they're both above 20 and continuing to go up. And our bias is negative with the down day, and our momentum for the last 2, 3, 4, 5 days is also continuing to be negative. The economic reports, I don't have all of the charts to show you here, just the ones that really have an impact on the market. Personal income came in lower than expected at 0.3%. They had expected 0.4%. Last time it came in up 0.4%. Personal spending, this is what shocked the market a little bit. It came in up 0.7%. They expected it to be up 0.5%. Last time it was up 0.4%. The PCE prices were greater than expected at 0.4%. They expected 0.3%. Last time it was 0.4%. This is the one that the Fed really pays attention to, and this kind of kept things under control to a degree, where the core PCE came in at 0.3%. That was as expected, but up from the 0.1% that we saw last time. Consumer sentiment came in at 63.8. They had expected 63.1. Last time it did come in at 63. Here's a chart of personal income and spending. The blue line is spending, and that's turning back up ever so slightly. It's probably a little bit hard to see, where income is actually underneath. So people are spending more than what they're bringing in, and that leads to more debt. On a year-over-year basis, when we look at inflation, it is continuing to go down. So that's somewhat hopeful, as the other inflation reports that we've been seeing seem to be showing some improvement here. So the market kind of like that. Personal spending on a month-over-month basis, it did really pick up as we're going through October. Or actually, this is September, but then into October. Here's consumer sentiment, where we follow the blue line, which is consumer sentiment, the total reading that I have a chart for. And that is going down, where we're seeing expectations looking out into the future. That's also declining. And how people are feeling about things right now is also declining, as people are rather pessimistic right now. Here is the consumer sentiment chart. That's the blue line, where has been decreasing lately. And we're still seeing a really wide spread between the blue line and the red line, which is the 2-year Treasury yield. Typically, we'll see these going in the same general direction. And even though they're on different scales, they tend to not get that far apart from each other. They've been really wide from each other now for a couple of years, and often going in opposite directions. We did settle unchanged with the 10-year yield at 4.85%. That's still above the 4.02%, which is probably going to bite into earnings expectations. Here's the intraday chart, where we had a higher open at the daily pivot, and then we just jockeyed around between the daily pivot and the unchanged level. Tried to break out a little bit, but that didn't really see any follow through. Then we fell back down to the unchanged level, which had been acting as support, but then we ended up going negative down to S1. We skated along S1 for quite a while, dropped below it, never made it down to S2, and then saw a little bit of buying going into the close, and we were just a little bit above S1. Looking at growth versus value intraday chart, you can see both of them are down. The red line and the blue line have been in a pretty steady decline as of late. And then our ratio between growth and value for the S&P, it did show a little bit of improvement later in the day. This could be just a little glimmer of hope, where for the last number of days, we've been seeing this going down overall. To see this going back up, especially on a Friday before a weekend of big geopolitical potential events occurring, this is rather positive. Our growth to value ratio is pretty much unchanged. It's still hanging in there. So this is under the surface, potentially positive, where we are still in a longer term uptrend. Keeping an eye on discretionary, which continues to show some weakness, even though it was up in Friday's session. We closed near the top part of this bar, which may be a little hard to see, but we have seen a recent death cross here with this equal weight ETF. The staples continue to show weakness, which is not necessarily surprising. We've been seeing a lot of that in 2023. So when we look at our ratio at the bottom, it did tick up, not very much, but it's still in a longer term uptrend, but now it's chopping more or less sideways recently. Looking at the condition of our trend, we have the ADX above the moving average. That signals a strengthening trend. The red line's on top and advancing. That signals a weakening or declining trend, where the green line continues to go down, seeing pretty much that same thing with our short-term ADX chart. So short and intermediate term, we are negative. Keeping an eye on the VIX, wondering this little bounce up that we've been seeing in the VIX, is that what's happening here as we get further into the latter part of October? Now, we're also potentially coming into some positive seasonality when we get to the last couple of days of October and into November, and we'll have to see. We've been kind of following our seasonal patterns for the most part. We'll have to see if that's going to pick up. Usually from the end of October into the end of the year tends to be pretty positive during a pre-election year. The Ulcer Index is showing that fear is continuing to increase. We're back above 20 with the VIX, with the line chart, and we're also above it with the bar chart, showing that fear is really increasing. Volatility didn't really pick up all that much, especially before a weekend where a lot of people might have been hedging some things. They may have done that earlier in the week. But this is actually showing where volatility is kind of maintaining the same level that it has been. But when we look longer range at our VIX to VVIX ratio, this ratio is going up, and that's negative for stocks. The VIX to 3-month average of the VIX, the red line is what I follow. That's continuing to go up. That's negative. And the VIX to move ratio is also going up, and the moving average is starting to go higher. That's negative. The one-day equity put call ratio did tick up, but not as much as you would necessarily expect. So when we look at the 5-period simple moving average, it's now starting to go back up, and that's negative for the market. The longer-term equity put call ratio is also going back up, and that's negative longer term. We did see an increase of this fear gauge as it's starting to go back up. Our other fear gauge is also showing an increase. So we're seeing folks out there not all that complacent about things. Even though we ticked up slightly in Friday's session with the risk on, risk off ratio, we still are declining overall. We're going to have to see this really turn around to show some improvement. The mass index, this is looking like a false signal at this point. We never got up to the blue line, and we're already starting to turn back down. So I wouldn't necessarily consider this to be a valid signal. We may get some other charts that do give us a valid signal, but not necessarily this chart. We are seeing a decline when we look at the advanced decline line based on price and volume, well below their moving averages. We're also seeing a real expansion of new lows as stocks keep going lower, and so our 5-period and our 10-period continue to decline. We're not extreme negative yet with our advanced decline ratio, but we are below zero and declining with the blue line and the red line. Accumulation distribution, which tries to measure the smart money, it is declining and below a declining moving average. The chicken money flow is also turning more negative. This is another smart money indicator. And we're just breaking below support right now as far as our daily chart of the S&P. On the bottom, you can see where volume was above average. And we're maintaining this above average stance for the last week or two. Now, here's a chart that I don't show that much. This is the rate of change going back 10 periods. We're starting to get extreme negative. This compares Friday's session with 10 periods ago and saying maybe we're starting to get to the point where we've gone down pretty far, pretty fast. You can see other times when we did get these readings, it didn't necessarily mean a reversal. Sometimes it did, but other times it didn't. So we need to have other confirmation. And when we look at our rate of change going back 20 periods, this is also starting to get extreme. It could still go down further from this, but we're heading into that territory. Now, our short-term indicators, the Stochk RSI, it's still extreme negative, as is the Williams percent R, the CCI 14, and the CCI 20. So in the short term, we're getting more and more oversold. Here's the 20-period exponential moving average study where it's turning back down and looking extreme, as is the 50-period exponential moving average. The 200 is still declining and not extreme yet. The force index, the second day in a row now that this has gone down and is actually hitting the lower Keltner band here, suggesting that we've gone down pretty far, pretty fast. And all of our stochastics, in the short term, we're extreme, intermediate term, and long term, we're getting extreme negative readings. The boom indicator is giving us an extreme negative reading in the 20 period. It's dropping below this 100 level. We're also starting to get extreme now in the 50 period. This is the intermediate term. The 200 is not extreme yet, but it is declining, so that is negative. The Erin indicator ticked down just a little bit. I'm not sure where the green line got this from to measure all these buyers coming in. That's what really shifted this oscillator up after Wednesday's session. But we're still negative since we're below zero right now. The red line's on top. That means that sellers are in control, and the green line's underneath it, meaning that buyers don't have as much influence. Looking at the cumulative NYSE advanced decline line, we're continuing to show weakness and breaking below previous support. We're also breaking below with our regular NYSE advanced decline line. Not a real positive sign. We might come down to this previous low and be able to set some kind of a support level there. And I wanted to show this, the other NYSE advanced decline line. I was showing this as we were going up with the trend line. The reason I'm bringing this up now is we're seeing a death cross with this NYSE advanced decline line, and that's not a positive sign. This is a positive sign. The Swenlin trading oscillator for the last 2 days, based on price and volume, even though it's negative, it has been turning back up. So that's potentially positive there. Where the go, no-go system is a deep purple, that is negative. The TTM squeeze is looking more negative. The balance of power is also looking more negative. We're starting to drop down with the red line with our lowest low value. That's beginning to roll over now. And the midpoint is also headed lower. We're getting further below the 200-day simple moving average. And the CMB composite, we don't get a lot of signals from this. This is supposed to be a standalone trading system where you use the combination of the lines and which direction this is going. I use it like an oscillator when we get extreme positive or negative readings. Please keep in mind that I put the black lines on here, so there's nothing magical about them, but we're starting to get an extreme negative reading for this index. And this is a chart that I haven't shown. The last time I showed this was to show that we've actually climbed up fairly well off the October 2022 low. Now, we hit a high on July 31st, and now, according to this chart, we've fallen over 11%. That's when we take the intraday high with the intraday low, so that's a little bit more than the closing points, but this is now considered to be correction territory by its textbook definition. The vortex continues to be negative with the red line going up and the green line going down. The ease of movement is also below zero and declining. The BPI is continuing to fall. It's under 30. At some point, is it going to bottom out and turn and go back up? We're waiting for that. And we're starting to get extreme negative with our S&P 500 McClellan oscillator. It's just barely going into extreme negative territory. So our summation index based on price is declining, and we might come back. Let's see if we are able to turn around if we hit this new low. We're still declining and pretty much in free fall based on volume. Looking at our NYSE summation index, we're continuing to decline based on price and volume. You might be able to make a case that we might find some support at this level, but we're going to have to see a real big improvement first. On a trend basis, the elder impulse system for the S&P remains negative with red bars. Don't show this one very often either. The standard deviation. This is how far is the stock now compared to where it was 10 periods ago. It doesn't measure direction. It just measures speed. And with this really starting to spike up, that means that we've been going down pretty far, pretty fast. The RSI based on 14 periods is just barely starting to get extreme negative. The RSI based on 9 periods has been extreme negative for a couple of days now. On balance volume, declining below a declining moving average. That's negative. And we're starting to really break down with our 200 moving average study for the S&P 500 and those stocks that make up the index. That's really falling off. We haven't exceeded this low yet with the 50-period moving average study. And we're breaking below support here with our other 100% short-term fib level. We closed just a little bit underneath that on Friday. And we're also breaking below this longer-term 50% retracement level. So this is pretty significant support that we're starting to break through. And we're further down now below this 4208 level. We're wondering, are we going to come down to the 4020 level? That's where I have this next fib, double fib level. We're breaking below this quadrant line here now. That had been pretty significant support. For a while, it had been resistance, but now we're starting to break down below that. And this is another chart I haven't shown in quite a while here. And I just talked about this in the deep dive video where when I created this chart, I went from the June 2022 low, the October 2022 low, and drew a trend line. And then I did a parallel line from the all-time high and then just extended it down. Well, when we were going up last spring and into the early summer, this was providing some resistance, but we were able to break through that. Now we're starting to come back down. Now we still have about over 100 points in the S&P to get to this level, but I have to bring this chart back up because this may end up providing some kind of support if we continue to fall. Pring bottom fisher still generating a buy signal, but now starting to roll over and regret that. On a momentum basis, we're negative with the PMO. We're also negative based on price and volume. We're not quite extreme with the PMOs that are rising. We're still declining with the buy signals, and we are extreme negative with the PMOs that are above zero. We're starting to get extreme negative with the NYSE bullish percent index. That's broader range. And if this continues to fall, that just means the rest of the market is pretty negative. And the NASDAQ 100 is getting close to this 30 level. It closed right on 30. If it falls below and then turns and comes back up, that could be a pretty significant buy signal, but we're not seeing that yet. And if you're one to want to try to front run some kind of a rebound, we're not seeing any confirmation in the charts of that, at least yet, because things like the slope oscillator still showing that we are negative. The MACD, intermediate term, we are negative. All of our oscillators now are headed lower, suggesting that our momentum is negative. We're well below the 200-day simple moving average now, and we're dropping below this other moving average, going back to the all-time high. This is an anchored moving average. This was pretty significant support, and now we've closed down below that. We're also in the -3 standard deviation, showing that we've gone down pretty far, pretty fast as far as this chart is concerned. We're almost extreme negative with the Chaikin oscillator, but for right now, we're just flat negative. Where the money flow is below 50 and declining, that's negative. The ultimate oscillator just barely starting to get to an extreme negative reading. And for the last year or so, we haven't had any of these signals. So this is pretty significant. The Sean trend meter also getting extreme negative and starting to bottom out just slightly. We're still negative, though, when we look at the parabolic SAR with the dots on top. We're breaking below all the trend lines here on this chart. So all of this support level has now been broken on a closing basis. We're dropping down with our 150 and 200-day moving average study. And we're looking a little more negative now with our special K chart. We're dropping below the moving average now. And when we look at the Dow, we're breaking below support. We might have some more support down at these previous lows set back in March. Transports are showing a lot of weakness now, and we saw a little bit of follow-through weakness in the utilities on Friday. The transports are really underperforming the Dow. So when we look at a ratio between the transports and the S&P, this is just really going down strong. In a solid environment, we want to see this ratio going up. And their relationship between the two, when we look at the S&P and transports, continues to be quite strong. They're both going down. And we're showing here that the Dow is outperforming the transports. We want to see this ratio going down in a more positive environment. The Zohorchak still hasn't changed yet, even though there's a one-day delay on this. After giving us an extreme reading, which is a buy signal, it's been coming down, but we've seen this now for about a week. The Staples to S&P 500 ratio is going up, and that is negative for stocks, where the S&P to utilities ratio is going down. That's also negative for stocks. We're starting to show some more weakness with our 10-day average of the S&P highs minus the lows. We did get an extreme negative reading. We're showing some improvement. Now we're starting to come back down again. And we're looking more negative with our 19-day exponential moving average of the advanced decline ratio. It's not quite extreme yet, but showing weakness based on price and volume. We set another new 52-week low on Friday with the micro caps. So when we look at our different chart variations, the Heiken Ashi is negative with black candles. The Kege is negative with a red line pointing down. The Renko is negative with red boxes. And the 3-line break is also negative with black candles. We're seeing here where the equal weight index is really underperforming the weighted S&P 500. And we came down a little bit in the ratio, but this is holding up fairly well compared to what else is going on, where we're seeing the microcaps doing just a little bit better than the rest of the market. The Dow is now breaking below support. We broke below this pivot level and we're continuing to fall. Another few days and we might see a death cross for the Dow. So on a trend basis, we continue to be negative with the diamonds. This is what I'm wondering is if it might play out something like this. The 200-day moving average that's pretty significant that we haven't hit yet is the NASDAQ 100. Are we going to come down to this level and be able to bounce up off of that? Are we even going to get that far down? Or is enough of support and oversold conditions to the point where the market might be able to see a bounce right now? But this is what I'm going to be watching on Monday. Looking at the trend, though, for the QQQs, we still remain negative, even though they were up about 0.5%. However, when we look at the PPO, which measures momentum of the NASDAQ 100, we continue to be negative. We're below zero and below the moving average. We're dropping below the 61.8% retracement level here for the NASDAQ 100. If we start to come back up, is that going to provide overhead resistance? Or are we going to continue to fall and hit this 50% level? The NASDAQ has already broken below its 200-day moving average. And so this is looking more negative. And we're coming down to this 38.2% fib retracement level. Will this end up providing some kind of support if we continue to fall? We're looking negative with the small caps. They were down. We closed just at this pivot point here. So that support is holding. And with the Russell, we're going down and looking extreme with the RSI. We're working off of a death cross. Our momentum is also negative for the small caps. On a trend basis, we had been neutral. Now we switch back to negative and we're breaking below recent support. When we look at the mid caps, also breaking below support here. Not a good sign, working off of a death cross. My goodness, here I am most of the way through the video and I'm losing my train of thought. With a trend basis, we are negative with the red bars. Sorry about that, folks. And we actually saw the FANG index go up. This is where Amazon, Apple, Facebook, Netflix, Google, that's where these stocks reside. And so this was actually up 1.34%, but it has a ways to go back up to its 50-day moving average. This is another point of concern with the FANG index. We dropped below this support level. Are we going to continue to fall, or are we going to be able to get back up and get above this previous low? We're dropping further below the longer-term arithmetic scale going back to 2009. That's not a good sign. Looking at our growth to value ratios, where the Qs did outperform the S&P, discretionary had a fairly good day compared to the S&P, and we turned back up slightly with large cap growth versus large cap value. So with our growth to value ratios with the large caps, we're seeing more improvement, just a little bit of a tick up with the mid caps as well as the small caps. Longer term, our 50-day exponential moving average of the new highs minus the new lows, that continues to decline. That's longer term negative because we're still below zero with our indicator. That's causing the 50-day moving average to decline. And our moving average study for the S&P 500 based on 50 periods, we're getting down here. We're not quite extreme negative yet, but we're getting close. The mid caps are also showing some weakness, and the small caps continue to show some more weakness. When we look at the highs minus the lows and take a 5-period moving average of the broad market, we're continuing to fall here. That's suggesting broader range negativity. The dollar was down slightly, but it's still in a longer-term uptrend. The financial sector, we have a death cross here. Just barely, but the blue line is now crossing below the red line. We're now down to this support area. Now, we could fall a little bit below this. You can see other times where it fell below and then was able to recapture that. right now we're right at this support level. And interest rates actually could have helped the market. They ended up being unchanged. They were up on the day, but ended up closing down for the 10-year yield. And bonds are starting to really outperform stocks on a short-term basis. Longer term, they're continuing to underperform. And I wanted to look at the S&P 1500, which is a broad range measure. It's starting to fall below the rainbow when we do a ratio compared to the 1 to 3 year bond ETF. When we look at another broad market ETF and compare it to further out bonds, we're also seeing weakness as stocks are really starting to underperform bonds. The 30 to the 5 year still remains back to normal, and the 10 to the 5 is still normal. The 10 to the 2 year showing some improvement, but is still inverted. The 10 to the 3 month ticked down just a little bit, but it has been showing some improvement. However, it's still inverted. We're still seeing a positive result when we take the 10-year yield and subtract the German 10-year yield. This is going up. The dollar has been going up, and the correlation between the two is quite strong, which is probably negative for stocks. Tom Bowley, now we're coming into this last part of October where his research has suggested that we tend to see up days. We'll have the 30th and the 31st left in October. So what's our outlook for Monday? We're still dealing with earnings season. The UAW strike is still continuing, and there's been some progress made with Ford. We're still wondering if things are going to escalate in Iran, and there was word that Hamas actually went to Moscow and had a meeting there. That could really make things a lot scarier. The technicals are negative, and we're breaking below long-term support. Are we getting to the point now where some kind of a base could be forming? You could say yes. You could also say no. We're not really seeing any uniformity right now. We won't get any economic reports on Monday, and then the geopolitical events are really what's driving things. We have what happened in Syria Thursday night. We have what's happening in Israel right now, and then anything that develops over the weekend. Here's the economic calendar for the upcoming week. I've tried to highlight the ones that seem to have the most influence. On Wednesday, we're going to get ISM manufacturing. That's when the Fed's going to come out with their rate decision. It's not necessarily a mystery what they're going to do. It's what are they going to say in their statement, and then what is Jerome Powell going to say in his press conference that comes after that. And then we're going to get the big employment report on Friday, as well as the ISM non-manufacturing index. So we have a couple of days where some major things are hitting the markets at the same time. Stock Traders Almanac, though, for Monday, October 30th, we're positive. 61.9% of the time we are positive on this day. So when we look at this, we will be on the 21st trading day of the month during a pre-election year. The green dashed line, we tend to see some improvement. Historically, we've also seen some improvement on this day. And now we're wondering, have we bottomed out here with the green line during a pre-election year? Will we start to go up for the last couple of days? Carson Research, are we getting near the end of this downward part before we do start to go back up? And we're seeing kind of that same thing with the NASDAQ. Have we bottomed out here? And will we see a bit of a bounce? Also, we're seeing a bit of a bounce historically for the S&P 500 during our pre-election year. We tend to be up more than down for October, but that's really running into question right now. And then Bitcoin is falling back just a little bit. It got up into the 35s, and then it ended up closing down in about 34. It's getting close to a golden cross here, so that could turn this a bit more positive. So our scenarios, we still have to go with the down one. Our technicals are negative, and we continue to break below longer-term support. We're not going with the up one yet because we're just not seeing much confirmation there. You could say seasonality, but we haven't really seen that in any of our charts yet. And we're not going with the sideways trend because our both ADX charts are showing that we're in a strong trending environment. The warning signs, this list is pretty long. The daily special K chart, it's crossing negative. The longer term equity put call ratio is going up. The risk on posture continues to show weakness. The 5-period equity put call ratio is back to going up. Our oscillators show that for the S&P 500 and the NASDAQ 100, the momentum is negative. The bullish percent index for the S&P is back below 30. The Vortex and the parabolic SAR charts are negative. The 50-period exponential moving average study that we do with the new highs and new lows, that's negative. The Russell, the small caps, and the mid caps are just generating recent golden crosses. The financial sector, this is a new addition, has now generated a death cross. And then I guess fill in the blank here for the last bullet point. Look at how short our positive list is here. We have two things. The Pring bottom fisher, which is kind of totally out to lunch right now, or so it would seem, and small and mid-cap growth is still positive in the longer term. Our conclusion, we're negative. We're in a confirmed negative trend, and we are below support. In the short term, we're becoming even more oversold than what we were after Thursday. We're even more negative in the intermediate term, and we're falling below support that way. And we continue to be negative in the long term since we're below the 200-day simple moving average. So thank you. I hope you found this helpful. I will be putting out the weekly video, the intermarket analysis video, and the deep dive video over the weekend. I hope you find all of these together helpful. Have a great weekend. May your team win the World Series, and I will talk to you in the next video.